It's 11 p.m., and you've got two tabs open. One is Zillow, a house that's just $436,000, at a mortgage rate that makes your stomach hurt when you actually calculate the monthly payment. The other is your apartment listing app, showing you the same rent you've been paying for years, quietly going up again at renewal. And you're stuck in that same loop everyone your age seems to be stuck in right now. Am I throwing money away by renting? Or am I about to trap myself in a huge payment I can't actually afford? If you've ever had that exact tab switching moment, stay with me. Because in this video I'm going to show you the real 2026 numbers behind renting versus buying, the hidden costs nobody warns you about, and exactly how to figure out which one is actually right for you. Quick note, I'm not a financial advisor or a real estate agent. This is a framework based on real data, not personalized advice. And if this kind of real numbers breakdown is useful to you, subscribing helps this channel keep making it. Let's get into it. Here's a number that should get your attention. According to Federal Reserve data, the median homeowner has a net worth of around $430,000. The median renter? Around $10,000. That's a 43-to-1 gap. Now, before you panic and go make an offer on a house tomorrow, that number is misleading if you take it at face value. Homeowners, on average, are older, higher earning, and more likely to be married, which naturally pushes their net worth up regardless of the house itself. So this isn't proof that buying instantly makes you wealthy. What it does prove is that this decision is too important to make based on a gut feeling, a family member's opinion, or a rule you heard once and never questioned. It deserves actual math. So let's look at what's actually happening in the housing market right now. As of right now in 2026, the average 30-year fixed mortgage rate is sitting around 6.7%. The national median home price is around $436,000. And the national median rent is around $1,965 a month. There's a specific tool that tells you, mathematically, whether your local market favors renting or buying. It's called the price-to-rent ratio. You calculate it by taking the median home price and dividing it by a full year of rent for a similar home. Here's the rule of thumb the industry uses. Under 15, buying tends to win. Between 15 and 20, it's a genuine toss-up that depends on your specific situation. Above 20, renting usually wins on pure monthly cost. Right now, the national price-to-rent ratio is sitting around 16 to 20 depending on the source, which means, nationally, we're in that gray zone. Not a clear win for either side. Your specific city could look completely different. Now let's calculate your own number. This is the first thing you should actually do before making this decision, not feel it out. Calculate it. Find the median home price in your specific area, not the national number, your city or neighborhood. Then find the median monthly rent for a comparable home, and multiply that by 12 to get the annual rent. Divide the home price by that annual rent number. That's your local price-to-rent ratio. If it's under 15, the math is currently leaning toward buying. If it's over 20, renting is currently the stronger financial move. If you're somewhere in between, which is where a lot of the country sits right now, the decision comes down to the next few factors we're about to cover. This one calculation alone will tell you more than any opinion you'll get from family at dinner. Here's the part that catches almost every first-time buyer off guard. Buying a home isn't just the down payment and the mortgage payment. Round-trip costs, the closing costs when you buy, plus the realtor commission and fees when you eventually sell, typically eat up 8 to 13% of the home's value. On a $436,000 home, that's potentially $35,000 to $56,000 just in transaction costs alone, most of which people never budget for. And that's before you even move in. On top of the mortgage, the average homeowner pays close to $16,000 a year in maintenance, homeowner's insurance, and property taxes combined. That's not optional spending, that's the real cost of ownership that never shows up in the monthly payment number lenders show you. This is the actual trap, not that owning a home is bad, but that people compare rent to just the mortgage payment, when the real comparison should include all of this. Once you add it in, the math often looks very different. Now let's talk about the one factor that changes this entire equation more than anything else. At today's mortgage rates, the point where buying actually becomes cheaper than renting, the break-even point, typically falls somewhere between 7 and 14 years, depending on your local market, rent growth, and those transaction costs we just covered. That number moves a lot with rates. If mortgage rates were closer to 4% instead of today's roughly 6.7%, that break-even point could shrink to just 3 to 5 years. So here's the real question to ask yourself, more important than almost anything else in this video. How long do you actually plan to stay in this home? If the honest answer is less than 5 years, the transaction costs alone make buying a financially risky move in most markets right now. If you're confident you're staying 10 plus years, the math starts favoring ownership a lot more, even at today's higher rates. Here's where this gets interesting. There's a trap hiding on both sides of this decision, not just one. The renting trap is the "you're throwing money away" guilt, the idea that if you're not building equity, you're failing somehow. That's not automatically true. If you rent and consistently invest the difference between renting and owning into something like an index fund, you can build real wealth without ever owning property. The buying trap is different. It's social pressure disguised as a financial decision. Buying a house because you feel like you're supposed to, by a certain age, or because everyone around you is doing it, even when the math for your specific situation says rent. This is the same comparison trap from before, just showing up in a different form this time. Quick question for the comments. What's your local price-to-rent ratio? And has this changed how you're thinking about renting or buying? Curious what people are actually seeing in their own city. If your math points toward renting, either because your break-even timeline is too long, or your local price-to-rent ratio is high, there's one move that makes renting actually build wealth instead of just feeling like money gone. Take the monthly difference between what you'd pay owning versus renting, and actually invest it, consistently, the same way we talked about in our index fund video. That gap, invested for years, is exactly what closes a meaningful chunk of that 43-to-1 net worth gap we mentioned earlier, without you ever signing a mortgage. Renting isn't the failure mode. Renting and doing nothing with the difference is. Whichever side of this decision you land on, here's what changes once you've actually run these numbers instead of guessing. You stop feeling that 11 p.m. tab switching anxiety, because you're not comparing your life to some vague idea of what you should be doing. You have your own price-to-rent ratio, your own break-even timeline, your own plan for the difference if you rent. Renters stop feeling like they're failing. Buyers stop feeling like they rushed into something blind. Both sides just feel like they made an informed decision instead of a guess. If you haven't already calculated your actual net worth or seen where you stand for your age, that's the natural next step. We broke down the real Federal Reserve numbers in a previous video, and it pairs directly with everything we just covered here. And if renting is the right move for you right now, our video on getting started with your first $1,000 in index funds shows you exactly where that difference, your savings, should go. Let's go back to those two tabs, Zillow on one side, your rent listing on the other. You don't need a gut feeling to close those tabs. You need your local price-to-rent ratio, your honest break-even timeline, and a plan for whichever path you choose. You've seen it today. Why this decision matters more than most people treat it. The real 2026 numbers, how to calculate your own ratio, the hidden costs nobody warns you about, your break-even timeline, and what to actually do with the difference if you rent. If this was useful, hit subscribe for more real, data-backed breakdowns like this one, and drop your city's price-to-rent ratio in the comments. I'm curious how different this looks depending on where you live. Whichever tab you close tonight, close it because you did the math, not because you guessed.